I always try to put a title to our presentations. This quarter, it's more pressure and emerging concerns. I think over the last few quarters, we've seen this buildup of market pressure in terms of any number of things. But as we looked at um, the numbers were holding in terms of inflation and the labor market and GDP and these other things. And now we're starting to see some emerging concerns in the numbers. And I think that that's the big thing that's different this quarter than in prior quarters. So that's kind of the theme of what I've been thinking about. In terms of financial markets, let's just check in on the markets, the things that we know for sure. We look at broad market indexes, and these are as of August 4th. The S&P is having a pretty good year. It's up over 7.5%. The Dow's hanging in there pretty well as well, 4%. NASDAQ is leading the domestic markets up just over 9%. But if you get much broader in terms of the equity basket, you see that there's some pressure, particularly in smaller cap stocks, and the Russell 2000 is really just it's negative, but just about even so far this year. As we've seen in the past, the European markets, particularly international developed markets, are doing quite well. They had been outperforming domestic markets year to date. uh, they continue to across some indexes, but the outperformance was greater than it is now. Um, China's come back pretty well. It's nearly at 7%. And as we look at kind of the whole basket of equities across the global marketplace, the MSC All Country World Index, it's up 10% year to date. So that's where we are in terms of some of the market, the equities. If we look at the S&P 500, just where we've been this year, you can see that we've recovered from the lows in early March and or late March, early April, and the markets are at all-time highs right now. Um, it's hard to explain exactly why that's the case. It is the case. We'll take it. And we hope that it will continue to be that way. But this is the path that we've been on so far this year. In terms of sectors, um, all but two or three sectors have been positive this year. Energy has been down about 9%, just given global demand for energy. And then healthcare, with the turmoil that's happening in the healthcare marketplace, particularly with regulation and oversight. It's just been a disruptive time for healthcare. Real estate's coming in about even, but otherwise, the market has broad breadth in terms of positive returns. Technology leading the way, communication services, which includes Google and Meta and some others. And then you can see other sectors as well. So broadly pretty healthy so far this year. If we look at the top 10 stocks, and we've talked a lot in last quarters about the Magnificent Seven, but if you just broaden the aperture a little bit and you look at the top 10 stocks, we can see that they continue to be very dominant in terms of representation of the overall market and the returns. The top 10 stocks today account for just about 38% of the market value, which is, really very top heavy, where the market is quite dependent on these top 10, the largest stocks, primarily technology companies. And despite representing 38% of the market capitalization, they contribute about 32% of the earnings. So we just continue to keep an eye on this. It's been something that we followed for some time. In terms of price to earnings ratios, we're still right around that 22%. It's just above what we would expect at a one standard deviation. It's higher than a 30-year average. Um, but there's some that argue that it's fairly valued and that we should expect a higher multiple given kind of the makeup of the market today. But that's where we are. In terms of global equities, I've ran into this slide. I just thought it was interesting, and I don't know that I have really anything super insightful. other than just an observation. The US equity market, domestic equities, make up about 2/3 of the global market capitalization. And it just underscores the importance of US domestic equities. Of course, US domestic equities have international exposure and they do business internationally, and it's a global phenomenon, but it does represent 65% of the global market capitalization. It falls off pretty quick from there. You can see Europe in that purple, the emerging markets, 10% in green, and Japan at 5%, and then everybody else rounds out the rest. So it just is a reminder of the importance of US domestic equities and their dominance in the market. Thinking about fixed income, just a quick snapshot. The 10-year Treasury today is yielding at about 4.25%. You can see what it's done over the past year. In terms of the yield curve, just comparing today's numbers relative to a year ago, the current numbers are in black and a year ago is in blue. And we really think a lot about the spread and we negative inverted yield curves and the like. Today, the 10-year Treasury, as I said, is yielding 4.25%. That's up 30 basis points from a year ago. But I think that it's interesting to see that the short end of the market, the blue, has really rallied in terms of yields coming down. And it's been the long end of the market for a number of dynamics that's had the weakest part of the yield curve. And it's why the foundation has had a bias towards the middle to shorter duration and maturity bonds in the portfolio. And that's proved out to work well for us. Another way to think about the yield curve is just the 10-year Treasury yield minus the 2-year yield. And that really kind of speaks to the slope of the yield curve. And in the pink below, anytime there, it marks a negative yield curve. We've been out of a negative yield curve for some time. And again, it's just checking in and it to make note of that. So the economy and the Fed. Let's do this in two parts. First, kind of looking back and kind of what we do know. Inflation was printed again in June or for June as of last month. And there was an uptick in inflation. It was up 2.7% year over year, 2.9% if you exclude food and energy. Some many months ago or some months ago, at a 9 handle on inflation, it's a significant improvement. But it is an uptick, and we'll see if it's seasonal, if that's a trend or not. But it certainly has the attention of the market that there was an uptick in June as published in July. The jobs report, created a lot of turmoil. This most recent release, first, it was lower than expected. We only added about 73,000 jobs in July. Normally, in July, we would see, something more healthy just in terms of seasonal jobs. But I think what really caught the market's attention is the revision down of May and June, not just by a little bit, but by a fairly significant amount. And the May and June numbers were revised significantly lower. And I think that there's a concern about just the politicization of the numbers. The Commissioner of Bureau of Labor Statistics was sacked right after these numbers were released. And, there's just a question of just the integrity of the numbers now. So it's kind of a two-edged sword. The numbers were revised down, and there's some question about just the integrity of the numbers now. So we'll see what happens here, but it's one of these emerging trends. It's an emerging concern around the labor market. We see it also around just in terms of the slowing of job growth. You can see this in a broader aperture, that the last 3 months are, fairly significantly lower than the trends that we've seen in the past few years. So this just puts it into context, and I think helps us realize that something significant may be happening here. So it continues to hold in right around this 4% level. There's a slight uptick in terms of unemployment. It's something to watch. Again, I think that could be categorized in this emerging concern, potential emerging concern. But again, as we've been working over the last several quarters, these numbers have been solid, and this is really the first few months that we're seeing cracks in all of this. So again, it's something that we need to watch. GDP is the same kind of theme. GDP was actually negative in the first quarter, and we're expecting positive GDP in the second quarter, but not much. Not at that robust growth that we'd seen in previous quarters. Um, that all leaves the Fed at a place where, despite political pressures to lower interest rates, they're continuing to take a wait and see approach. And there's a lot of pressure, as you know, on the Fed right now. Um, President Trump was at the Fed just a couple of weeks ago. Had the governors in a headlock talking about lowering interest rates. And there was a Fed governor that resigned recently, and it's been replaced by someone, Stephen Moran, who is a critic of Chairman Powell and really aligned with the White House. And there's some sense that he may ascend to higher positions at the Fed going forward. So there's a concern not only with labor statistics or economic statistics, but a politicization of the Fed potentially. Another emerging concern, something to watch. But as of now, the Fed continues to hold steady in terms of Fed funds rates. So looking forward, I think looking forward, if we start with kind of policy and what's coming out of Washington, the current administration is based economic policy around, three legs of a stool. They've been talking about tariffs, deregulation, and taxes. And looking forward, we have a better sense of what may be happening with tariffs. We've got the reciprocal tariffs coming back on to varying degrees across economies globally, but there's a better sense of what that may look like going forward. Deregulation continues to emerge. It's kind of a one-off. There's not a broad thematic policy, but rather it's industry regulation. It's special interest by special interest. And then, of course, taxes. We know now what taxes may look like, and it's the one big, beautiful bill. It's great for those that were seeking tax relief. It kept in place the 2017 tax cuts. Um, but for people that are less economically fortunate, it's going to leave a bruise. And I think that for all of us, it's going to add about $3 trillion or $3 trillion of additional debt um, to the forward-looking federal deficit, which is moving in the wrong direction. And I think that that's one of the factors that has pressure on 10-year treasuries and longer-term fixed income yields is this competition for debt and just the flooding of the market of debt. So, maybe short term it's stimulative. The White House will say that it is, and it's going to pay for itself. I'm concerned about it just adding more debt to our deficit. And it depends on who you ask. The White House thinks that the big beautiful bill will be a catalyst for growth. You can see in blue their economic forecast for GDP growth as a result of the big beautiful bill. But if you look at other sources, the tax foundation or the CBO or others, they're less convinced that this is going to be a stimulative positive thing for GDP going forward. I hope the White House is right. And of course, we going forward are still wrestling with tariffs. Some countries, the EU, the UK, other countries have struck deals, so to speak, but there's still a lot that's unknown. India, China, other Asian countries, certainly South American countries. So there's still unknowns, and it's creating uncertainty in the marketplace, economic uncertainty, and the Fed measures these things. The Federal Reserve in St. Louis has an index for it, and you can see just visually there's a big spike in economic uncertainty. And I think the policies and just the effect of these policies are driving uncertainty in the market, and that's not good for us. That's not good for markets. The markets hate uncertainty, and you can see that there's a spike there right now in terms of the Fed thinking about going forward. Uh, uh, there's a projection that there's going to be a slowdown in GDP from about 2.1%, the November forecast. It's coming in lower than what was forecasted. It was forecasted at 2.1%. It's going to be 1.2%. Core inflation is higher than what had been expected. So, based on expectations, growth is lower, inflation is higher, and it just adds to this sense of headwinds and growing uncertainty in the marketplace. And again, it's just one of these emerging kind of concerns that we're dealing with right now. The Fed's expecting a far rockier economy in the second half of 2025, higher unemployment. We saw that it's at 4.2%, ticking up slightly, and they're thinking that inflation will break that two handle and be something around just north of 3% going forward. So, again, a concern, and it doesn't bode well. Rising inflation doesn't bode well for those that want lower interest rates. Couple of notes to end on in terms of positive. The Wall Street Journal did a survey at the end of July and just asked the likelihood of a recession in the next 12 months, compared April forecast to July forecast. And there's a sense that, maybe a recession is less likely. We'll see what happens, but it's a survey, and it's a snapshot of market sentiment. John, to your point of a crystal ball, this is a magic 8 ball. We don't have one right now, but it would be nice to have one. The one that we have is kind of it's hard to discern exactly which way we might be going, and I think that that's the sense of the market um, is just uncertainty, and there's just an uncertainty right now, and again a concern around some of these emerging um, concerns in the market that we're seeing. But I think that probably the best way to end is with the way that Chris ended his quarterly note to us. And through faith, we encounter our human limitations and uncertainties, trusting the overall purpose of God's creation to multiply and magnify love. While we can't predict every turn of the market, we can stay rooted in our principles that prepare us to weather the storms of life. In both faith and finance, we are called not to act in fear, but to act out of trust. And I think that that's just really, really wise counsel to us in all matters. And it's a reminder that, we're very often tasked with being long-term investors and thinking not just around the next quarter or the next year, but the next generation and beyond. And I think Chris's words are really important, especially now.